Okay, so this is the last presentation of the conference. So thank you all for sticking around, and I'll try to make it as enjoyable as possible. It's also a good opportunity to thank the organizers for this fantastic conference. I can say personally, this is the first time I'm attending GCGC, and it's a wonderful experience. It was a terrific conference. So this is a joint project with my friend and colleague Yaron Nili, and it's about an interesting recent phenomenon in the private equity world, the rise of continuation funds. So in the traditional private equity models, usually the sponsor liquidates the assets of the assets of the funds after 7 or maximum 10-year period. But recently, we have observed a new phenomena where the sponsor sells the asset, moves the asset to a new fund established by the same sponsor. That's the continuation funds, and it's some sort of a related party transaction. And investors, at least some of the major investors, are becoming frustrated. Some of them think it's a pyramid scheme and that private equity funds selling assets to themselves at an increasing pace, it's not good for the business. The SEC has also started to intervene, and as you probably heard, the Fifth Circuit just invalidated the recent effort in the field, including in the area of continuation funds, but we'll talk about it later. But those allegations, to some extent, they are vague and they are a lot of broad, and there are a lot of interesting questions on the table, including what exactly are the conflict of interest that are created in these situations, what are the winners, what are the losers, what are the market ways to deal with the continuation funds, to what extent they are effective, what else can be done. And that's exactly the goal behind this paper, right? So first, to put forward the first comprehensive account of continuation funds, to analyze both the benefits, but the concerns that they generate. And because private equity is to some extent a black box, there is not a lot of publicly available information. So we also provide qualitative data from interviews that we conducted to provide some insights on the theory of private equity bargaining and the reality of continuation funds. And lastly, we explore the policy implication, and this will be the order of my presentation as well. Now here I want to mention something that Roy already mentioned it, and Jill to some extent also earlier. We think that there is a lot of room here also, and this is a great venue to think about it. We think that there is a lot of room here for financial economists and additional empirical work on continuation fund. You see, this is more theoretical analysis. We try to do something with the data. It's complicated. There are data limitations. I can speak with you about it, but we feel that there is a lot that can be done on that regard. The other general note that I want to provide is that in the background, there is a heated debate about private equity more broadly, and to what extent the sponsors are taking advantage of the sophistication to divert more benefits to themselves. Those are just two examples of leading scholars that criticize what's going on, try to undermine the notion that we have here really bargaining between two sophisticated players. And we think that continuation funds is another interesting setting to examine all of those questions. So it's another window where we can address those important issues. So before I get into the analysis, just to make sure we are all on the same page, a quick introduction as to how it works. So in the usual scenario, the GP, the sponsor, will approach the LPs of the legacy funds and we tell them about the intention to establish a new fund, the continuation funds, and to transfer either a single or multiple assets into the continuation funds. And then the legacy funds LP will have the following option. They can either cash out or roll over their interest into the continuation funds. At the same time, the sponsor will approach new LPs and try to persuade them to invest in the continuation funds. The new LPs will infuse new capital to the continuation fund, and some of it will be used to cash out basically the legacy funds LPs will elect to basically liquidate their positions, and this is more or less how it works. Now, another important point to emphasize is that this has become a really growing trend, a really popular trend in the private equity space in the past few years. Before then, continuation funds were used mostly for struggling, distressed assets. They call them zombie funds. And in the past few years, we see them being used also for high-performing assets. And the most important point is that the total deal value of this transaction increased significantly from about 11 billion in 2016 to almost 70 billion in 2021. And here you see the red boxes. Those are GP-led transactions, mostly continuation funds. The blue ones are secondary transactions done directly by the LPs, and we see how continuation funds have grown in their volume. Now, the supporters of the continuation funds try to describe it as a triple win story, and those are basically the strong justification behind why they are doing it. So they are saying for the GP, it's a win because they can hold the assets for an extended period of time without selling it to another buyer. For the LP, legacy funds LP, it's a win because they can get the optionality, they can choose. And for the incoming LP, it's a win because they can invest in more mature asset for a shorter period of time. But you know, when everyone tells me that something is a triple win story, there are also reasons to think about what could be problematic in that story. And part of what we do in the first part of the paper is to analyze the potential concerns that this type of transaction could raise. So there are clearly benefits, but there is the side of the potential concerns that should not be ignored. So the first thing we put on the table is that the GP has very clear private benefits and strong incentives to establish this continuation funds transaction. Why? Because they can get management fee for an extended period of time after most of the meaningful work has been done, because they can enjoy the upside of additional carry when they sell the assets from the continuation funds and conduct the real exit. It's like a call option that the longer the option is, they benefit more. They can reset the carry. So if they see that they are unlikely to meet the original fund thresholds, they take just the successful assets, move them to a continuation funds, reset the carry terms, and are able to get carry. They get an extended control of these assets. And in about 30% of the cases, actually, it's interesting, they conduct this type of continuation funds transaction relatively early in the process. So in this type of situation, they crystallize the carry interest, they reduce the risk, they get liquidity for themselves without conducting a real exit. The other thing that's going on is that it really undermines the traditional private equity model. If you think about it, in traditional model, again, there are some issues there as well. With traditional model, the GP is a faithful agent negotiating an exit on behalf of the LPs. And here the GP is in much more complicated situations. It has dual loyalties sitting on both sides of the deal, representing two groups of investors whose interests are in a direct conflict. The existing LPs, they want to sell at the highest price possible. The new LPs, they wanted to buy at the lowest price possible, and the GP is in between. Now, we know that this conflict is quite severe because 80 to 90% of the original LPs sell their interest in the continuation fund transaction. So those are totally two different type of investors, almost two different type of investors. Now we spend a lot of thinking when we work on the paper to understand what's the upper end, what's the lower end in this type of transactions, what the winners and losers. But what we realize is that one thing is clear is that the GP will almost always win from this type of transactions because of the benefits that they get from this transaction, regardless of who has the upper end. And the other thing we show that if at all, the GP will have potential bias toward the new LPs. Why? Because those are the investors that the GP have to convince to come on board so everything will happen. Because those are usually repeat players that specialize in secondary transactions. They have ongoing relationship with the GPs. and they are repeat players, pure repeat players in that sense. And sometimes they also promise to infuse more capital, staple commitments to other funds of the GP. And there is some empirical evidence supporting exactly this point by Josh Lerner and a few other researchers, showing that how the GP provides some benefits to preferred investors through this type of interactions. The other thing we show, and that's the last part of the theoretical analysis, is that this can also create overall efficiencies, suboptimal utilization of capital, extending the time frame to maintain or basically to keep managing underperforming companies for fees, exacerbating the information asymmetry problem in private equity by removing the 10-year yardsticks, basically undermined a lot of the basic features that we have in the private equity model. So that was the theoretical analysis, and then we move, and then I'm going to go to the interviews and show what happens when our theory meets reality. As I mentioned, we interview people both on the LP and the GP sides, basically people who were on all of the most important transactions in continuation funds. They basically have a lot of experience covering this market. In addition to the interviews, we also collected data from comment letters that were submitted to the SEC and other publicly available resources. So one thing that we ask the LPs, and this is something that came up again over and over, is why they are so frustrated with the continuation funds transaction, right? If they get the optionality, and that's the story of the GP, so what's wrong? They can choose. And the picture that we receive is much more nuanced. So their story is that where they are being offered to conduct this type of transaction, they are basically being pushed with their back to the wall. There is a very limited time frame that they need to make this selection between 15 and 20 days. It's impossible for them to do this type of election so quickly, especially for public pension funds that have investment committee and they have to go to the investment committee. It's considered a new transaction. It's complicated. They don't get all the time all the information necessary to conduct the analysis. They don't have the expertise to do this type of work. I mean, the whole reason they invest in KKR, with KKR or Apollo in the first place, is that they don't know how to value specific assets, and now this decision is pushed to their court and they have to make it. They suffer from other additional constraints, so liquidity constraint, diversification, they might not be able to invest in specific asset, they might be over-allocated. And so that leads them to sell, even if this is not in beneficial terms from their perspective. And indeed, there is also evidence that a lot of these transactions are done in a discount and still they have to take them. There are also agency problem going on, internal agency problem going on at the background of the professional who sit in those asset management, where they have to delay their exit, think about their Christmas bonus, etc., for 5-6 additional years if they move it to the continuation funds. And I think what we show here is a line again with another pieces in the literature that highlight the limited bargaining power of some of the LPs because of collective action problems and internal agency problem, etc. The other thing that we were interested in is really about the role of reputation. And here, again, it's interesting because we saw that there is a clear differentiation between different types of LPs. For the small LPs, when they are frustrated, there is nothing else like they think that they can do. Their ability to retaliate if the GP misbehaves is limited. On the other hand, for the large and sophisticated LPs, they have more relational trust contract with the GP. There are multiple interactions, so that's why they trust. For them, reputation may work better. The other thing that we found is that there is almost no use of litigation in this space. So even if the LPs are frustrated with the GP, they will never file a lawsuit against the GP. And the idea behind it is that no one wants to have this reputation of limited partners who file lawsuits against the GP. And this is an interesting point that we we are now elaborating, because we think it's an important piece by itself, so we're elaborating it in a different project. And then the third part of the paper is about the market way to address this type of conflict. So in the interest of time, I'll just put on the table, maybe I'll discuss one important solution and we can discuss the rest in the Q&A. So one clear thing that is being done in these situations is to get the approval of the LPAC. LPAC is a committee of 3-4 large LPs who are basically cleansing and approving the continuation funds transaction. And in theory, it may make sense because those are the large investors and they have the highest stake on the line. But what we see also here, again, through the discussions and the interview, is that there is a lot of mistrust in that process as well. And here is the idea that the LPAC are repeat players. They are sitting on many LPACs at the same time. They have a lot of interactions with the GPs. They are selected by the GPs. They don't have fiduciary duties to the other LPs, like we think about it from the public companies context and special committees. It's a totally different story because there is no litigation, there is almost no norms that are set by courts in this regard, so the process is very obscure. So there is a lot of lack of trust when it comes to the LPACs. The other thing that I want to put on the table is the suggested reform by the SEC that was invalidated in the meantime. So the SEC, the suggestion that they came up with was to require the GP to obtain a fairness opinion. Now, something interesting that we discover in that regard is that if there is something that the GP and the LPs, people on both sides agree about, is they didn't like the SEC solution. They didn't like the fairness opinion solution. And the sponsor said that from their perspective, it will mostly add unnecessary cost and that this type of mandatory obligation does not fit all of the situations they have to deal with. The LPs were skeptical of the fairness opinion, but for a different reason. They said, well, we'll invite the investment banking firm that provide a fairness opinion. This is the GP. The GP is repeat players. There is a small group of investment advisors, investment bankers that provide this type of fairness opinions. They are looking for the next business. There is a lot of room to navigate in this type of opinions. In short, we don't really, we cannot really trust this type of opinions. They don't want the paper they are written on. That was the idea behind it. And in the last part of the paper, again, we put forward a couple of alternative proposals that I think could enrich the discussion when it comes to continuation funds. Due to time consideration, I will just focus on one proposal that I think is the most interesting one, which is basically to empower the legacy fund LPs, right? So the idea is to provide them more say in that game. Currently, they are bypassed because of the LPAC process that I just discussed. So idea will be to bring this decision to the LP base, to the initial LP base, to the legacy fund, so that they can decide whether they approve the establishment of continuation funds or not. Think about it. It's similar to the approval process that we see in public markets as well, in this type of conflicted transactions following MFW, etc. They will also have a say on the selection of the financial advisors, especially those who oppose the transaction. And we also suggest to invite at least the largest LP who oppose the transaction to sit on the LPAC committee, to have a seat on it in the committee that oversee the transaction. So why don't I stop here and we'll take it from there.
Okay, terrific. Thanks, Kobi. Okay, discussing assignment.
Thank you very much for the opportunity to comment on this paper. I would just start by saying that I really like the paper. I think it's an excellent paper. I think it's balanced. I think it's a clear and easy to read exposition of the conflicts of interest that arise from continuation funds, and highlights some of the ways in which those conflicts can be resolved. I actually learned a lot from the paper, even though I already knew quite a lot about continuation funds, and I think it's thought-provoking in some of the alternative solutions that are offered. I therefore don't have very much to offer by way of criticism. I think they get the descriptive part of the paper right, and their data, including from semi-structured interviews, I think allows them to describe what's going on in the market pretty effectively. My own experience is different in terms of the attitude of LPs. I think that the flavor you get from the interviews you do is different from the experience I have talking to GPs and LPs, but your experience from your interviews is your experience from your interviews, so I can't quibble with it, except to say I don't think it's necessarily representative of the LP market as a whole. So the article starts by referencing Barbarians at the Gate, the book and the film that, of course, depicts KKR's takeover of RJR Nabisco way back in the late 1980s, over 30 years ago. I'm not actually convinced that this reference is particularly relevant to the article or indeed to my discussion of it, but I'm delighted they mentioned it because it gives me an opportunity for some shameless self-promotion. This is, in fact, the front cover of my book, Corporate Governance and Responsible Investment in Private Equity. I'd like to say it's available from all good booksellers, but it's actually not really available from any booksellers, good or bad. I do have a copy with me if anyone wants to dip into it. In fact, the copy I've got with me is very rare. It's a rare unsigned copy of the book. Anyway, the front cover of my book has a picture on it, and that's why I'm putting it up here. The picture is a relief that depicts the prostration of the barbarians. As Kobi and Yaron are quick to point out, much has changed in the private equity world since the takeover of RJR Nabisco, and we may have different views about whether private equity is now in a position of prostration, but my experience, and I've advised many private equity firms over the last 30 years or so, is that private equity is now more humbled, if you like, at the feet of an increasingly demanding group of stakeholders and regulators, certainly much more so than it was in the 1980s. What we've found is that, not surprisingly, as the market's grown and as the market's matured, investors have started to solve the collective action problem with investor associations. The most notable one is ILPA, the Institutional Limited Partners Association. They recommend reporting templates, model clauses for limited partnership agreements. They issue best practice guidance, and they have obviously also issued best practice guidance about continuation funds, which is talked about in the paper, and which I'll come back to talk about in a moment. There's definitely much less information asymmetry now than there was in the past. That's partly due to the work of academics, which has been really valuable, but also journalists, even filmmakers. There's more competition in the market, and there's significantly more regulatory oversight. That regulation is particularly prescriptive in Europe, where the AFMD regulates most private fund advisors, private equity fund managers. And I'll come back to that, but even here in the US, as you know, since Dodd-Frank in 2010, private fund advisors have been subject to SEC oversight, and I can tell you they worry a lot about SEC exams. So, of course, despite what's changed, there are still problems. I teach a course at LSE on private equity and venture capital, and we spend most of the course talking about those remaining problems. There are still information asymmetries, there are still frictions, but I think they're a lot lower than they were, and I think the market has taken care of quite a few of them, and the regulators have tried to take care of some of the others. I think most of the innovations we've seen in the last 30 years have been positive, and actually my story is that the subject of this paper, continuation funds, is another positive innovation in the market. It's easy to tell this as a barbarian story, as a market failure story. It's easy to argue this is all about private equity fund managers exploiting their position to take advantage of investors. But I don't think that is the story. In fact, it's possibly part of the story, but it's certainly not the whole story. It's not the most important part of the story. And to be fair to Kobi and Yaron, they do tell the story in a pretty balanced way in the article, and I think they emphasize the positives and the negatives. To me, the question is why do these funds exist? Is it just because private equity sponsors find them a good way to make more money, or are there other reasons for it? And then having understood why they exist, the question is, what should we do about them? And management of the conflicts is the key point here. And to be clear, no one wants to ban continuation funds. The authors of this article don't suggest banning them. The SEC didn't suggest banning them. Investors certainly don't want to ban them. So nobody's arguing, as far as I know, that we shouldn't have them. The question is, how do we manage the conflicts that arise? Okay, so continuation funds, they're not new. I actually worked on one in 2011. I don't really talk about it because it was a failed continuation fund because the investors wouldn't support it. The LPAC weren't supportive of it, and so it didn't actually proceed. But obviously, many have happened since, and they have proliferated over the last few years. In the early days, as Kobi said in his presentation, these were to deal with difficult assets, hard to sell assets. That's rarely the case now. These are almost always now trophy assets that have been performing very well, and the GP wants to continue to manage. So as I say here, continuation funds are actually a solution to a problem. So let me just explain in a slightly different way to the way Kobi explained why they exist. The problem that limited partnership style funds seek to solve is that private equity funds invest in illiquid, hard to value assets. Investors obviously need liquidity. They don't want to invest forever. They need their money back at some point in the future. In a public fund, an investor asks for their money back pretty much any time. The asset manager sells some assets in the market, funds a redemption, or the fund is listed on a stock market, and the investor sells all or part of their stake in the fund to another investor at the current market price. That's not possible in a private fund. Here the assets are illiquid and hard to value, so redemptions don't work, and usually private equity funds try to avoid the costs of a market listing. There's no ready market for the fund interest, and investors, if they want to sell, can only sell in a private secondary market. So the solution is we have a limited life closed-ended fund. And a limited life closed-ended fund means that the manager promises to hold the asset for between 5 and 7 years, sometimes a bit less, sometimes a bit more, but then sells, and instead of reinvesting the proceeds, distributes them to investors. So investors who don't need short-term or unplanned liquidity, like pension funds, insurance companies, endowments, and so on, they cope with this. They want exposure to the asset class. They accept that limited illiquidity in exchange for a promise that liquidity will come within this defined limited life fund span. That means that we don't have to value the assets in between, or at least if we value them, nothing really turns on it because nobody's redeeming interests on the basis of a valuation. It means that we don't have to sell assets at an inconvenient moment. We don't have to go into the market and sell an asset because investors want their money back before our holding period is up. Investors like this market discipline. They like it because it means that every 3 years or so, once you've invested the capital, you have to go back to the investors and ask them for more money. And you have to explain to the investors how you've spent the money that you've just spent on their behalf and why you think they should give you some more. Investors can then decide whether they want to give you more money or whether they want to invest in a different fund. So this is an attractive model for the investors as well. And 3 to 7 years is actually quite a good holding period for a private equity type asset. Obviously, it depends on the strategy, and in venture capital you need longer, and buyouts you need less time. But overall, 3 to 7 years turns out to be quite a good holding period. It's the time that you need to make strategic or significant operational changes to a business. but it focuses the mind. So it's a defined period, meaning you have some time to make some change, to reorientate the strategy, to follow through on a plan to increase the company's profitability or revenue or whatever it is. But you have to do it, and you have to do it within a period. You can't put it off indefinitely. But 3 to 7 years isn't always optimal. Sometimes there are various reasons why market conditions aren't right to sell the asset after 3 to 7 years. Sometimes there are reasons why you want to sell sooner to lock in a price. Sometimes the market conditions mean you just can't find a buyer at all. Sometimes, as we are in a position now, investors are demanding liquidity. They want to be able to commit to new funds, but they're not getting distributions from their existing funds. So they're telling their GPs, we want some capital back, please. We need some capital back in order that we don't overinvest in that vintage and we can put new money to work in the vintages that are coming through now. If everyone wanted just to keep the asset for longer, of course, you wouldn't need a continuation fund vehicle. You'd just have a fund extension. And if investors are happy with that, they can just vote to extend the life of the fund. You can just hold the asset for longer. That's fine. But that's usually not going to work here because investors have different time horizons. And many of them have been promised liquidity within 5 to 7 years, and they want it, right? They want the money. They need the money. They don't want an indefinite or significant expansion of the term of the fund. So that begs the question, what if the GP has to sell at the end of the period or wants to sell at a particular point and feels like it or a fund managed by it is going to pay the best price? If they think that the best way to sell this asset for the highest price is to a fund that they manage, the question is, should they be allowed to do that or should they not be allowed to do that? If they can offer the best price to the existing fund from a new fund, should they be allowed to do it? And I would say, yes, of course they should be allowed to do it. If the new fund is willing to pay a price that's at least as high and if not higher than the market price, is able to offer liquidity at a time when the liquidity might not be available in the market and the investors want it, then it seems to me that it's right that that's what happens. By the way, I think the term continuation fund is a bit misleading. It's obviously the term that the market uses, but we should understand that it's a continuation, of course, for the fund sponsor, for the fund manager who continues to manage the asset. And for a few investors, but as Kobi points out, not very many investors choose to stay on. They mostly choose to sell out. It's really a new fund that's buying the asset. It's a new set of investors, predominantly, that's buying the asset from the old set of investors. So the article says it's often described, and I've often described it as a win-win-win. I'd actually say it could be a win-win-win-win. It's a win for the investors who want to stay invested. Kobi said this. It's a win for the investors who do want to exit at the current price, which is most of them. I don't find that in the least bit surprising. As I just said, most of them want liquidity. They've been promised liquidity at a particular point. This is the point they get liquidity. And the whole rationale for selling the asset is that most investors, the GP thinks, want liquidity. So it's not really surprising that when you ask them if they want liquidity, they say yes. The fund manager wants to continue to manage the asset, usually because they see significant further upside in the asset, and there's a new investor who's willing to come in and benefit from that upside. But also, and this is a point I think is a bit underemphasized in the paper, it is mentioned, the underlying business avoids the disruption and distraction of an M&A deal. It doesn't have a new owner with a new set of priorities, a new strategy. The management probably feels more secure because they're staying with the same GP that they've got used to. The continuation fund might often also offers additional capital. The new investors coming in fund new capital to go into the business to fund the next stage of its expansion and so on. And that means that in many cases, the sale price should be higher, right? If you just think about it from an efficiency standpoint, the GP knows the asset, transaction costs are lower, the management probably wants to stay on and continue executing the strategy. And so it's really not that surprising that the new fund managed by the same sponsor can offer as good a price as anybody else, if not better. But clearly, and I think it's a given, if there's a better price available for this asset, the GP should take it. And so that gets us to the web of conflicts, because obviously the GP is in a conflicted position, okay? The GP is on both the selling and the buying side. So for me, the question is, if the costs of mitigating this conflict and any residual costs that remain are outweighed by the benefits, then these are efficient transactions and we should applaud them. And the questions are, can we manage the conflicts? How do we manage the conflicts? And this is where the paper, I think, makes its contribution. It's really analysing the web of conflicts, describing the ways in which the GP is conflicted. Sometimes, in some respects, it wants to maximise the price for the exiting investors for a variety of reasons. In other respects, it's got an interest in siding with the new investors and buying for the lowest possible price. So there are various solutions, and this paper talks about some of them. One of the things I think that this paper doesn't do quite enough of is talk about the ILPA principles. So in May 2023, so a little over a year ago, ILPA completely revised its guidance on continuation funds. Now, ILPA, remember, is the Limited Partners Association. This is a group of investors. It's a very widely spread group of investors. Lots of people are members of ILPA. They consulted widely with their membership. Their membership said, yes, we're okay for GPs to do continuation funds, but we think they should follow the following rules in running the process. A well-run process is really important. And so this guidance recognizes that these transactions can create value, but asks, for example, for the GP to give the LPs more time to consider the offer, more information, and has a range of fairly detailed recommendations for the way in which the conflict should be managed. One way in which you can manage the conflict, of course, is to market test the price, because really, in the end, what really matters is the price. And the ILPA principles make really clear that the guiding principle for all of these transactions is to maximize the value for the exiting investors. What ILPA says is that these transactions have to maximize the price for those investors, which, as Kobi says, is the majority who are selling. All right? They're selling because that's what they expected. They're expecting an exit. They're expecting a sale at some point. This is the exit. As with any other exit, ILPA says the principle is you maximize the price that those exiting investors get. One way that you can do that is to market test the price. And this actually happens reasonably often. So one thing you can do, and that's what happened here with CD&R in a transaction which is probably now a couple of years old, but these transactions happen. They sold a minority stake to funds managed by Hellman & Friedman and BlackRock Private Equity. They retained a majority stake, but they went out in an auction process and they auctioned the asset just like they would normally to find the highest bidder. In fact, you probably might assume that the bidders were really willing to bid more, knowing that the GP is staying invested, that the strategy is going to be continuous, and that the GP is actually reinvesting its own money, its own skin in the game in the asset, showing confidence in the further upside. So that probably increases the price, might increase the price that the incoming investors are willing to offer. But in any case, this market testing gives LPs a lot of comfort. In this case, CD&R sold 39% to incoming investors, but retained the rest. Now, that's not always going to work. It's not always going to be the right thing. And so there are other ways in which you can think about how to make sure the price is the right price. The SEC came up with an idea, which, as we now know, is not going to proceed, but was also not particularly liked by either investors or GPs, as Kobi said. But there are other ways in which you can make sure that the advice that the GP is getting about the price is sound. I am generally a fan of regulation. That's probably not surprising because that's how I make my living, advising people on how to navigate regulation. But I'm generally, in areas like this, in favor of principles-based regulation. And as long as there's some sanction for failing to apply those principles, I think that can be effective. That's actually what's at the heart of fiduciary duty, isn't it? A very flexible duty that responds to the circumstances that the fiduciary finds itself in. And so I generally agree that some regulatory oversight is needed. And as I mentioned at the beginning, we certainly do have that in Europe, for example. We have the Alternative Investment Fund Managers Directive, which is which is regulating, gives, for example, a whole load of principles that have to be applied. Fiduciary duty, fair treatment of investors, proper conflict management procedures, regulation of preferential treatment. All of these principles you'll find in the AFMD, and at least there is in theory the threat of sanctions if a GP doesn't follow those requirements fairly precisely. So I'm out of time. I just wanted to if I may, mention one thing, which is that Kobi and Yaron mention a couple of potential solutions. As I say, I think they underplay the market-based solutions that are already out there, that the ILPA guidance encompasses. Maybe that's because the ILPA guidance was updated after they did most of their interviews. Maybe they'd have found a different view amongst market participants if they went and spoke to those investors now. I don't know. But anyway, the ILPA guidance, I think, does contain a number of really important recommendations, which for the most part are followed. They're not always appropriate in any particular circumstance, but they are, I think, very helpful. I'm a bit skeptical about LP votes. One of the things that is suggested, I think LP votes could be very difficult to manage. You'd have to do it both at an early stage to see whether there was an appetite, and then at a late stage, it'd be quite difficult to get a secondary investor negotiated with a secondary investor if there was a high risk that the deal would fail. As Kobi says, and I think this is a bit underplayed in the presentation, the approval of LPAC is required. The LPAC is the advisory committee that's comprised of the largest investors. I understand the skepticism of some of the smaller investors about the role of the LPAC, but if you get 4 or 5 really sophisticated, significant investors to approve the transaction, that's got to be a pretty good signal. And as I say, in some cases, the LPAC doesn't approve the transaction, including one I worked on, and getting them on board is no mean feat. I actually, though, think that the idea, which is mentioned briefly at the end of the paper, independent group of directors who do owe fiduciary duties to make a recommendation to the LPs, or maybe even have delegated authority, I think that would make more sense. Anyway, I've gone over time, so that's me. Thank you.
Simon? Kobi?
To some extent, by recent surveys, that shows that only 6% of the LPs shows a great level of interest in the continuation funds, and most of the LPs have no interest or moderate level of interest in the continuation funds. I think it's in line, like this type of survey are in line with what we had in mind. In terms of the proposed solution or the market solution, so I mean, we agree. I didn't have time. I skip it very quick when I did a presentation, so I ran to it quickly. I think that the competitive, if we think about all the market solutions that exist there, so probably the competitive solution, the auction is the best solution in that regard. We also agree with it. I think the problem here, there are 2 problems, right? The first one is that it doesn't happen all the time, because it's expensive and we don't see it in all of the transactions. And the second problem with that solution is that still the GP controls the entire process. And we know it from public markets, and we know it transaction with public companies, that when managements control the process, it's not a perfect process. And in the public company context, there is litigation that comes afterward that can challenge what the management is doing. So management is operating in the risk of potential litigation. Here, there is no litigation. We also know, and there are some examples, we provide one in the paper, that sometimes they skip transactions that are clear beneficial to shareholders, to the LPs, and it also happens because the process is not perfect. I mean, there is very limited things that the LP could do. I will also mention, you asked to what extent, I mean, if it's a beneficial deal, everyone is happy, but again, if you look at the data, you see that only 6% of these transactions are above the NAV, right, which still can be also manipulated. So a relatively limited number of the transactions are done in a premium. Most of them are done in a discount. And actually, I heard a really interesting paper by Josh Lerner that it's a work in progress just 2 days ago in another ECGI conference, where he showed that a lot of, again, it was LP sales, not the GP-led transaction, but he saw the same thing, that a lot of those are distressed sales. They are done in like pressure. And I think part of it's related to work that Emiliano did in the context of public companies, where they are pushed with their back to the wall, where they don't have a lot of options because they have to liquidate, and then they will take any price that will be offered to them. So I think the GP knows that as well, and they have interest on the other side, which makes think complicated. So I think this is something that we have to put into mind. ILPA, again, I mean, we ran to it very quickly, but all of the enhanced mandatory disclosure, increasing disclosure, providing more time to make these decisions, we totally on board. We agree. We put it in the paper as well. We discussed this with ILPA. We are skeptical. What we have seen in ILPA, it's clear. I mean, they changed their position. I think it's also interesting. They were really against continuation funds, and then to some extent they say, well, let's think about the LPAC process. Let's think about how can we ameliorate the LPAC process. But the LPAC is a complicated process because of the nature of the repeat players there and their repeat interactions with the GP. Those are the same investors who have a lot of repeat interactions with the GP, and so that's why we were more skeptical on that front of their solution. But everything about the disclosure, we totally agree with. And I'll say just the last thing. I think your idea to look at public market, to look at what's going on in the UK and everything. I think it's interesting in terms of thinking before regulation. I stop here.
Okay, Jeff, Jun, and John on the queue. Anybody else?
Right. So I bring a skeptical view of these funds, and to me, in the same way that pay-in-kind debt was a signal of the impending failure of junk bonds in the 80s, the CDO squareds were a signal about the collapse of the mortgage market. These funds, to me, suggest that the PE market, the form has overextended itself and certainly does not deserve the subsidy that, at least in the United States, that the special treatment of carry provides. And the reason is and frankly, both in the presentation and the discussion, there's no assessment of the systemic effect of funds such as these. So when I've been a fan of the PE governance model in a lot of my work, as maybe one other person knows, but and so when I teach about this in M&A, the question students have is, why isn't this a conglomerate, right? Because I teach about that too and why it failed. And because the assumption here is that the headquarters is able to manage in a very efficient way businesses across a wide swath of the economy and figure out exactly how to evaluate the management team. And we know that the conglomerate experiment failed and destroyed a lot of value, right? That's what the bust-ups of the 80s were all about. So here, that's the claim of these funds, that we essentially back up. So the answer I give to students is because of the exits. They are required after a period of time to exit the investment, which requires settling up so the market can assess exactly how good the PE firm is at essentially the business it claims to be good at. And also we cap in effect, or we limit the size of any PE sponsor's ability to manage a large part of the economy, which it's hard to believe that they're going to do in an efficient way. So this is the opposite of that. This gives, essentially, this recreates a version of the money trust of the 1910s. And the concern about that, among other things, apart from John Coates' point about power, is think about how this has happened. At least in the United States, where the IPO market is possible exit. I don't know about the UK market. So the initial story was we'll exit either through an IPO or a sale to a strategic. All right. So then the next move was we'll sell to one another. So basically, the CF funds we'll sell to ourselves. So as essentially the amount of dry powder goes up, the incentives to use it will go up as well because of the fees. And so it seems to me that this is just one further step, and it undercuts the key governance story as to why the PE model is appealing. And so, where does this push me? Well, as I say, we give a subsidy, at least in the United States, in the form of the special treatment of carry. Let's end it, right? I mean, let's end it X years ago, but particularly now, there's a great concern. Secondly, when it comes to the revision of the 2017 Tax Cut Act, the PEs face a cliff because that act essentially limits the deductibility of interest to 30% of EBIT, which worked great when the interest rates were 1%. So I'm curious as to what the legislative reform proposals are going to be as the 2017 Act requires revision. So all of these things, these important policy issues are up for grabs in the next year or two. And it seems to me that the CF funds provide another signal that we should think with great caution about the subsidies involved in the tax code towards this particular form. Final point is they're free riders on the public goods creation of disclosure by other firms, by the public firms. So they disclose nothing about the businesses that they engage in, right? That's an enormous competitive advantage not to be forced to make those disclosures. And so I don't see why the subsidy involved in that. I mean, so that's a subsidy in another way, a cost imposed in another way. And as I say, unless they can show that they're going to be super efficient in the management of real resources, then the subsidies ought to end. And I think the CF funds are signals that their ability to deliver extra value is coming to an end.
Seems like you should respond to that, Kobi.
I mean, actually, it's a very easy response because I agree with most of Jeff said. I mean, I think in that regard, I mean, we don't in our policy implications, we haven't thought about, the carry and the intervention through that. And I think it's a fair and important point. I will mention to that just another piece of the puzzle is that there is another practice. Again, I've heard another interesting presentation, a paper by Bobby Reddy about it, about NAV loans, the NAV loans that private equity are taking now, which is another bet against the market. I think there is the issue again of them playing different roles, being also private credit and in their capacity as controlling those companies. So I think it's all ties together, and I think it's very well put. So I mostly agree with it.
Okay, we have 4 people on the queue in about 6 minutes, so I'm going to group questions. So Jun and then John.
Yeah, this is a wonderful paper. I really loved reading it. You said that GP prefers new LPs, which means that they have incentive to sell the asset cheaply to the continuation fund. I agree your argument, but if you consider the carried interest mechanism that GP can receive by selling the asset in cheaply, which means that they can have I understand your argument, but sometimes a certain $100 now is much better than uncertain $150 in the future because they have expectation that the fund will go well, but it's not certain. So that isn't it an argument about that GP prefers new LPs on that sense?
Okay. Right. Yes. So just quickly with the last point, we agree with it. I mean, we agree exactly with the problem and the conflict of the LPACs, and this is something we try to highlight in the papers. So we are totally on board with that. We are with you. On the first point, I think what happens here is, again, they have superior information. We know that those transactions are done usually in discount because of the pressure situation that the LPs are in it. We know that they can catch up on the carry when they sell it to, when they conduct the final exit after 5 or 7 years. So, you know, again, it's complicated, but our sense is that they get, and another thing that's going, I mean, there is the reset of the carry that I mentioned, that sometimes this works in their benefit if they see that, you know, they are not going to make the carry in the legacy funds. So there are many ways that they can catch up on that. That's why we don't, I mean, we think that if it's going to be like a huge problem for their perspective, they are calling the shots. They are deciding about the continuation fund, so they will just, you know, close the fund. So that's why I think theoretically you're right, but I don't think it's a real concern.
Uwe.
Yeah, thanks very much for the very interesting paper. As also Simon has pointed out, obviously one of the main, if not the main problem, is the price fending mechanism, in particular when there is no outside market prices, which I would conjecture, given what you mentioned, that basically prices are often at NAV or below, that this is the case. So I wonder, because in venture capital there is one way forward, namely to see not cash distributions, but stock distributions on a case-by-case basis. Does your data tell you something about whether this is also possible, or is that always in cash distribution for LPs who want to exit?
Okay, and last question to Martin.
Yeah, I always find it valuable to come to a GCGC conference just to listen to one comment of Jeff, and so thank you very much. And of course, I also agree that there's no particular reason to subsidize them, but taking the subsidy as given the very small scale of the continuation funds, I'm tempted to think of efficiency explanations as well, right? So one being the asymmetric information one, there could be liquidity provision. Another one could be specialization of different types of funds. I'm thinking of Investor AB in Sweden. No, right? So EQT is one vehicle that specializes in buying out firms and, you know, changing management teams and whatnot. But then they might sell to Patricia, which is a different fund that specializes in, you know, holding stable cash flows kind of thing. So you could just have very different specialized funds and sell from one to the other. The transaction might just be more efficient without having an asymmetric information problem selling to the public markets. And I wondered to which extent you think that could explain some of the phenomenon.
Okay, so I'll take it in the reverse order. So I think, you know, what we see here is that it's the same GP who continues to control. Basically, it's a new fund established by the same GP. So, I mean, your story about specialization could be right in a sense where, you know, you see a situation where the GP sells it to a different GP with like a different set of skills, but those are conducted by the same GP.
It could be the same GP, but a fund with different risk characteristics, no? Maybe some funds are just, you know, stable cash flows, and other funds are more
you know, there is one interesting point, and it's related to what you mentioned. I think investors are extremely frustrated when the continuation funds transactions are done very early in the process, because they are saying, why? What's the rush of selling? There's this story that Simon tell where, you know, we are reaching the end of the life cycle. We don't see, I mean, the market conditions are problematic. Then still you can extend it by a year or two, it's not necessary, but they are really frustrated about, you know, something that is done very early in the process. And sometimes the explanation of the GP is like there are assets who have specific needs and we want to, like growth needs or something, and we want to isolate them from the other funds. But I guess there are also concerns there, right? If they're taking the best assets out of the funds and the legacy investors who, because of their concern, are unable to participate, create this type of conflict. And then I forgot the first question, but
with the
in kind distribution, yeah. So it's a good question. So what we see is that most of them, they want to liquidate and take the cash. Some of them, but it's very rare, I mean, some of them will do like half and half, like they will cash and they will roll over some of their transaction. But usually what we see is that they will just liquidate in cash. That's like according to the data we have.
Okay, before we turn things over to Jeff, let's thank Kobi and Simon.